Welcome to the Going Long podcast with FCLT Global. Today, our guest is Karl Kuchel. He is the Chief Executive Officer of Macquarie Infrastructure Partners and Head of Infrastructure Americas for Macquarie Asset Management. Over more than 2 decades at Macquarie, Karl has led the firm's infrastructure investments across transportation, digital infrastructure, utilities, energy, and waste, and has guided major transactions, including the acquisition of Long Beach Container Terminal and announced the $40 billion sale of Aligned Data Centers. So, Karl, thank you so much for joining me today.
Well, thank you for having me.
So let's start with long cycles. That's what seems to happen in infrastructure. And you've been at Macquarie for quite some time. You've seen a number of different market cycles. So what do you think about the current environment? What challenges are shaping the way you deploy capital right now? Just to give us a context of what does the market feel like to you today?
Yeah, no, it's a great question, and I'll respond primarily in the context of the US market. But we are really in the middle of an infrastructure super cycle today. What does that mean? Across so many sectors, the need for investment is at levels that certainly I haven't seen in my 20 years investing in infrastructure in the US. And the fact is, it really does pervade a number of key thematics. So it's not just one particular area where, certain investors are focusing, where they're seeing, this trend. It's really permeating a number of areas, whether that's rolling out fiber across the country, investing in data centers, which is probably the most capital intensive infrastructure sector that we've ever seen, whether that's investing in energy to respond to increasing electricity demand. There's a whole host of elements that really sit underlying that key title of investment super cycle. But what it means for infrastructure investors is that we see a lot of opportunities to find investments that suit our investors' needs.
So that it makes sense in that if we think about, I've been in the investment markets for many years too, and infrastructure is sort of, sometimes it goes, is on the front page, and sometimes it's sort of buried. It's definitely on the front page right now. There's just no question about it. But I like your term, the super cycle. And it feels like we need infrastructure in this country, but also in many countries around the world in ways that perhaps we haven't at other periods of time. Is that just because we've underinvested in the United States, or is it all about the new technologies?
Well, I think it's a combination of both. I think broadly speaking, you can break it down into structural tailwinds, but also cyclical factors. So the structural tailwinds that have been in place really for the best part of the last decade in particular around things like decarbonization and investing in green energy, and then digital and data, where all of us recognize that thematic because we're all part of it, as we consume more and more data. And so the need for infrastructure to underpin those thematics is clear. I think the key point that's really become evident in the last couple of years around these structural thematics is the convergence between digital and data, the compute and transport of data, which really then flows through to consumption. And then what are the inputs to be able to deliver that on the energy side? Then in some of the other sectors, which are generally more linked to overall economic activity, you've had underinvestment in some of those areas, but also some of those areas that have, where the rules around the economic model for some of those areas is changing. Things like supply chain, for example, where, a lot of just-in-time production in Asia coming through import supply chains, now considering things like onshore production or manufacturing of certain goods, friendshoring, generally thought about or used under the headline of deglobalization. So there are structural, cyclical thematics, but even within well-established sectors, there are new sub-thematics which are then generating the need for investment in existing infrastructure or upgrading, but also new kinds of infrastructure.
Yeah, it sounds there's a real combination, and you have a very global perspective. So it sounds like you're also comparing, for example, the supply chains and so on are moving from one place to another. Is there a lot more infrastructure investing in the Americas now relative to other places, or is it just that we're sort of catching up with that everybody is doing it, and we're sort of all in the same boat a little bit.
Oh, I think it's global. To
Oh,
be fair, I just think different regions or different countries are at different parts of the cycle. So something like digital and data, I think it's fair to say that the US has led and continues to lead. And you see, the major hyperscalers, for example, really focusing on the US market at the moment. But you're still seeing those same thematics flow through in Europe, and a number of what were traditionally US, data center providers expand into those markets. We've also seen the development of major opportunities in the Asia Pacific region around some of these same thematics. So I don't think it's just one particular region or isolate. So many of these sectors, and as you're pointing out, it can lead or support global movement of goods or other considerations. They're not isolated opportunities. And actually, a big part of infrastructure investing, I think, is being local, understanding the local conditions, the local stakeholders, those key considerations, but also the global perspective. Like, how does this fit into the broader picture? Because unless you get both pieces right, there is that risk that you may miss something in your underwriting and not be able to deliver what you need to for investors.
Right. That makes sense. And when you talk about stakeholders, many infrastructure projects really end up being public-private partnerships in some way. It's probably rare that you would just build an infrastructure project without worrying about any stakeholders. Can you talk to us a little bit about how that's working in terms of permitting, and how do you make those public-private partnerships work? Because a lot of investors don't have to deal with that side, frankly.
Yeah, well, I think I'd probably just describe, instead of sort of public-private partnerships, infrastructure investing is more generically about partnerships, because at the end of the day, what defines infrastructure is delivering essential services. That means your key constituents. You have your customers, local communities. There can be regulators, government entities, but also, for example, your large employee base. I mean, a number of our companies don't just have thousands of employees, but some north of 10,000 employees per portfolio company. So they're really large partnerships, both within the companies themselves, but also with external stakeholders. And so a big part of being successful is successfully managing and developing and maintaining those relationships. So whether that might be a safe workplace, maybe ensuring security of supply of those essential services to customers, being a responsible owner of these assets that deliver the services. There's a whole number of levels to that discussion about partnership and stakeholders. So, traditionally public-private partnership has sort of indicated non-government and government partners coming together, and that certainly can be an element of certain investments, sorry. But, I think it's much more broader than that from a stakeholder perspective.
Yeah. So you really have so many stakeholders that you're working with, whether it is the employees, the community, the local government, the somewhere else in the supply chain, whatever it might be. So it's a much more complicated investment than most. But I suppose that's one of the reasons that it's so important to get that right. Because you also can't it's not liquid typically. So you can't, if you get that wrong, that's not gonna help. So it's really interesting to me how you pull those things apart and understand all the pieces of it. And can you talk a little bit about how you look for those, how you either build those partnerships or how you spot places where that partnership might break down? How do you find those pain points?
Yeah, well, I think there's maybe a couple of pieces to pick up on that. I think in infrastructure, people naturally gravitate to the quality of the assets, the physical nature of these businesses. And that's clearly critically important in any underwrite for investing in infrastructure. But at the end of the day, it's a people business. And that may be the employees, the management teams, other stakeholders. And so you need to approach those relationships and developing and managing those, with the same level of importance as literally the underlying operations of these companies. And so when investing in this sector, it can start as early as just mapping all the stakeholders, understanding who is important to this business, who are the key constituencies, what are their views on these underlying portfolio companies that we may want to invest in, where are the relationships positive, in some cases where are they negative and need work in order to improve them. And a big part of us investing in infrastructure is making companies better. So it's not just about the status quo or where they are today, but like, where can we take it to? Where can we use best practices, our global platform knowledge and previous experience in similar investments to really improve not just the operations, but also those stakeholder dynamics and really deliver for customers.
Yeah, that makes a lot. I can sort of imagine this big map of all of the stakeholders that you must have. All right, that's extremely helpful. So let's come back. You mentioned a minute ago that this sort of convergence of decarbonization, energy transit, electrification, AI demand, data, all of this is coming together. And we hear a lot about this in the press, of course, and the need for so much power to fund data centers, to power data centers, the capital that's needed to build these out. Where do you see this going? Maybe describe it a little bit, what you see happening right now, and then where is this? Where does it go? Is it insatiable demand, or is it at some point we catch up?
Yeah, look, it's probably one of the key questions that people are grappling with today is, where does this whole thematic around AI go, and where and how should they invest in the thematic? And that's not just around the infrastructure piece, but just AI more broadly. I think on the infrastructure side, though, we have the benefit of underwriting more on the demand side or on the use side. And there you have to get comfortable with, the creation of data, the need for more compute, the need for infrastructure to deliver that data to end users on a real-time basis. And so long as you can get comfortable with that end demand, you can invest in the infrastructure that delivers it, whether it be the compute through data centers, fiber, towers, carrier hotels, a vast myriad of digital infrastructure. It can be a slightly different question on the supply side, as to, whether it be chips or various other components that are critical to the development of AI. And so, with infrastructure, that focus is very much on the demand side of the equation. And so if you believe in that, we're all consuming more and more data every single day. That's going to continue. If you think about AI and where we are, I mean, we're still designing apps for the iPhone, and we're almost 20 years in. Think about the use cases for AI that haven't even been contemplated yet. So that feels like a very long runway on the use case side, on the demand side. And so how do you deliver that through infrastructure? Data centers are central to that. And what that means is, as more and more data centers are required, more compute is required. That's putting pressure on the power side, with power and cooling being key inputs into data center capacity. And really the constraint today is all around power, because data center capacity certainly in core markets is constrained due to the lack of power. And if you think about power's ability to respond and deliver that increased capacity, it's not like flicking a light switch. It's nowhere near that easy. It's about building new capacity, and you've got solar and batteries. It's probably quickest to market. You've got a multi-year process to develop natural gas power plants, and then you've got nuclear as well. None of those solutions can be delivered tomorrow, but you're seeing this increase in electricity demand, which depending on who you read is somewhere between 2 to 4% per year. And put that in the context of the US power market, 1,300 gigawatts. You're talking about procuring an extra 20 to 40 gigawatts of power per year just to keep up with that run rate electricity demand. There is the power markets and regulated utilities and otherwise are just not set up today to be able to deliver that in the markets in which it's needed, which is why we've got these constraints. And so what you're seeing are things like data centers being built now in what we would consider non-core markets, not close to other data centers necessarily, or population centers, because that's where the power is. And the need for that data center capacity is such that that capacity is being built where access to power is the critical input. And that will provide some ability to keep putting more and more capacity into the market. But once that gets used up, it really is all about bringing more power into key markets. And the question is, how quickly can that be done? And I think under any reasonable estimate, at least for the short to medium term, power markets won't be able to respond to the demand needs that are coming through, not just from data centers, but from electric vehicles, increased electricity demand from industrial users. There's a number of components to that. And so anytime where you have a constrained market, it's good to be a supplier of capacity into that market, which is why you're seeing a lot of investment and construction of data centers, that even though you've got higher interest costs, higher capex costs, higher operating costs, inefficiency in the supply chain, that's still an important area for investment, because you've got that end user demand, and that they will agree to effectively economically pay those higher costs through higher contract rates.
It's a fascinating system where it's so, I think historically, at least, most people haven't thought about where the power comes from. As you said, it was just they just flipped on the light, but that just doesn't work anymore. So is AI not going to be able to figure out for us how to run AI with a lot less power? I mean, is this, is it just a one way? Is it just straight up into the right?
Oh no, look, it's a great question, and I think we're certainly of the view that increasing and compounding demand is going to overwhelm supply efficiencies. So we should reasonably expect improvements in chips and cooling technology and power usage. All of that should come through. I mean, I think you can look at what happened with DeepSeek, for example, as illustrative of that. What if AI models could run with fewer chips and less power requirements? And you can imagine that goes into, well, actually, what should the dominant chip maker be valued at? If there's a question about how many chips you need, or, can power and cooling efficiency be redesigned? But on the demand side, you're like, well, if that were to be the case and AI as an application becomes more accessible and cheaper, doesn't that just open up a whole host of additional use cases, which then leads to more and more demand, which then, feeds into the need for that infrastructure? So sort of coming full circle to some of my earlier comments, the infrastructure, I think, is being invested in fundamentally on the belief of this strong ongoing demand. Who wins on the supply side? Whether that be, chips and cooling and power, and who actually delivers that, I think is a slightly different question, even though they're all part of this same AI thematic.
Great. Now, I hear all that, and I also understand you recently sold Aligned Data Centers for about $40 billion. So why are you selling data centers if they're going up? Explain that to me. Is it just a matter of, price changes more than fundamentals, or what's the story there?
Yeah, so Aligned is a really milestone investment for us. And when we think about the journey with Aligned, we invested in 2018. And we supported the company from 2 sites originally, now to 50 sites, invested billions of dollars in growing that company over that period. But invariably, our job is to deliver returns for our investors. And having created a lot of value in that platform, we saw the opportunity to exit and deliver those investment returns to investors. And at the end of the day, I think it's a great question, because everyone sees these thematics. If I asked 100 investors, what thematics do you like in infrastructure? I would expect 100 of them would like, we like the digital and data thematic. So it's not a question of investing in the thematic. It's how do you deliver the returns you promise your investors out of that thematic? And that's really the journey we've been on with Aligned, where, we invested when the company was of a certain scale. we saw that the data center market was moving. We're a very early institutional investor in data centers from an infrastructure perspective, a number of years before others. We're able to really capitalize on that and grow the company. But invariably, having taken the company on that journey, it was time to sell and let the next group of owners take it forward. And Aligned is a fantastic company, and they'll continue to grow and be very successful, I expect. But what that means is, for us, we now move on to other investments in the digital sector and look to replicate those same returns for our other investors as we make those new investments.
And do you often find yourself as more of that early stage getting, I mean, like in this example, you said there were 2 locations and now they're 50, just sort of getting something off the ground more than growing something, more than monitoring and managing it? Or is there not a life cycle that you typically tend to drop into?
Yeah, no, it's a great question. I mean, we primarily invest in what are already substantial established operating businesses, but they're of a certain scale and where we see the opportunity to take them to the next level in terms of growth, doubling EBITDA, tripling EBITDA during our whole period. We see that opportunity to apply our expertise and experience, partner with the management team, and really execute on that growth plan. And what you'll see in almost every sector of infrastructure, and particularly in today's market, it is highly accretive to grow versus buy. And by that, I mean, to buy an established platform, you'll pay a certain multiple. But if you have the expertise to build that, your invested capital level will be significantly below, so that if you can exit at that platform value, you capture that value for your investors. So really the place we particularly see in the US market is there's a huge need for investment in infrastructure, as we were talking about earlier. And that's where we see the ability to create the most value for our investors. So we're really focused on staying in that particular part of the market where we can find established companies, those that have already demonstrated the ability to establish a business, grow it to a certain size. But because we really focus in particular areas, and we have market leading investment teams, we then partner with them, have an agreed vision for the company, but then we execute it and then exit and deliver those proceeds back to our investors. So it's a good question you ask, because infrastructure is not a defined term. Like it can be literally, fully contracted, lower growth, very core style of investing, and blends on a risk return basis all the way up to private equity. And you can really invest across that entire spectrum. But for value creation, I think we're really focused on applying that expertise that we have in a number of sectors to create a lot of value through growth. And so that's the area of the market, and the type of companies that we particularly focus on.
So something that you can build, take to the next level, not something that's, just pie in the sky, and not something that's more fixed income like. In other words, not sort of way down the path when it's just humming along. Is that fair? Yeah.
Well, certainly for if you want to deliver higher returns, invariably you need to deliver that business growth. That being said, for investors that want steady yield, more stable performance over time, which a lot of investors want that from infrastructure, there are products and types of investments that will correspond to that. So it's more the point of, infrastructure not being a defined term. It can be what an investor wants it to be. And it can be a case where most of their return can come from yield, for example. But there are other investors that almost want to take a private equity style approach to infrastructure. And there's no right or wrong answer. It's just a question of, where do you see the best risk adjusted returns? And invariably, if you can apply your expertise and build those assets and achieve an arbitrage on multiple on exit, that's clearly a place in the market where you can deliver those higher returns without taking on additional market risk. And it's really about executing on that business plan using that experience and expertise that we've generated through many investments.
Yeah, that makes sense. That makes bringing that expertise that you all have built around the world to these products. That's terrific. So, I know there are a lot of uh, investors who have perhaps not been as exposed to infrastructure in the past and have been feeling like maybe they've missed out a little bit or they're trying to get exposed. Some people have been very exposed, mostly the larger funds, I would think would be the case, but a lot of the smaller institutions have had less exposure to infrastructure. Do you think this is something that's really just how do you think about the match between the type of investor and the type of infrastructure? Is this something that is really just for the bigger players to play in, or is there a way for somebody to dabble in it a little bit more, as
Oh,
a plan or an endowment, something like that?
yeah, no, it's a really good question, and invariably it comes down to an investor by investor discussion. And it's about what are they looking to achieve out of their overall portfolio, and then what role can infrastructure broadly defined in delivering those objectives. Without sort of going down the list of all the characteristics that people often quote for infrastructure, yeah, you can invest in infrastructure in a way that you get diversification and various other benefits to the portfolio. But on that risk return that I mentioned, certain investors will gravitate to different parts of that risk return spectrum based on what they want from infrastructure. And so that then guides, well, how much do investors allocate out of their portfolio? And this could be everywhere from retail to the largest institutional investors. But then even within that allocation, where do they invest along the spectrum? And there's no right or wrong answer. Certain investors will be looking for stability and income. Others will be looking for capital accretion and are happy to take on a higher risk return proposition. But I think the attributes of what infrastructure can bring to a portfolio, broadly speaking, are being appreciated more and more by investors, because compared to general private equity or real estate, infrastructure is still a younger asset class. Macquarie's obviously been part of that journey for more than 30 years globally, but 30 years compared to some of the other private investment classes is still short. But as we've gone through a few more cycles, whether that be the global financial crisis, whether that be COVID or various other periods of stress, a big part of investing in infrastructure is that stability of return over time. And as investors see more and more examples of infrastructure delivering, I think it gives them more confidence to incorporate infrastructure in their portfolio. So as a general point, there've been early movers in infrastructure that have been investing for decades. And there are other investors that have yet to start their journey. But I think there's a lot of interest in infrastructure across the institutional investor set, but also now more and more moving into wholesale and wealth, where these attributes of infrastructure are viewed as beneficial for all investor portfolios. So, the overall level of interest is increasing. But then I go back to that point of, well, what does any particular investor want out of infrastructure as an investment class? That will really determine how they should access and what type of products or exposures are appropriate for their portfolios.
Yeah, no, that makes a lot of sense. And most, I think, if you sort of think about investors traditionally, they may not have, they sort of start in one place and then add something, add something, add something. So there probably are people who are still sort of, adding infrastructure, adding some other things that perhaps that they hadn't in the past. But there obviously are some who I'm sure have been on that journey with you since, for those decades. And to your point, I would assume this is, I mean, it's true in equity markets as well, which of course is, what I've grown up in, but you always learn lessons from the, like you said, COVID or GFC or whatever. That's true for everybody, but I'm sure there are different ones that are learned in each space. So,
Yeah, I think that's right. Maybe the last point I'd make just on this is, as investors build out their infrastructure allocations, the discussion is no longer sort of that single question of, is this a good investment strategy in infrastructure for my portfolio? Invariably, they're going to develop a variety of exposures, even in the infrastructure investment class specifically. And so it's not just, is this a strong investment strategy? It's that, like, actually, how does it dovetail, or is it complementary with the other infrastructure exposures I have? And so as investors continue to invest in the class, more and more it becomes sort of a two-pronged question of, is this an investment strategy that we like, that we think will create value for us? But actually, is it also diversifying or additive to the broader set of infrastructure exposures I have? And you're seeing more and more investors saying, actually, it needs to tick both of those categories to be considered. Whereas if you go back 10, 15, 20 years, it was much more just about that first question. So investors are thinking thoughtfully, not just about individual allocations, but how does their pacing and overall infrastructure portfolio build out so that they've got a complementary set of exposures in their program.
Yes, as you said, infrastructure is not a defined term. So once you look under that, what are all those things and how do they all fit together? Right. That's
correct.
That's really helpful. So so let's now put on our sort of look far in the future. We've talked a lot about some of the things that are going on right now. As you invest, you must try to think. I mean, no one has a crystal ball, but try to think. Where are we going over the long run? If we were having this conversation in maybe 5 or 10 years from now, what do you think will be really different? Some things I assume would be the same. The diversification would be the same. So probably some of the global tensions I would assume would be the same. But what do you think will be really different if we came back and picked up our conversation in 5 or 10 years from now?
Well, I think if we're thinking about that time frame, I mean, we have some major thematics in infrastructure where a large percentage of the capital allocated to infrastructure is being invested. So I think 5 to 10 years down the track, we'll be able to mark the scorecard as to who invested well and who potentially, while they might have been investing in strong thematics, didn't invest in a savvy way. So it won't be so much about how things are different, but I think as we've seen this weight of capital invest in digital, in supporting increased energy generation. There will be winners and losers, and a lot of investors will often ask me about, well, what keeps you up at night? What's your number one concern? I think around these really strong thematics that a lot of investment is going into at the moment, is just around, actually the risk is just paying too much for the strength of the thematic. Even if you're investing in a great area, if your investment case is such that sort of everything has to go right, that's not a symmetric outcome set. And as we talked about earlier, lots of investors, or all investors, see these structural thematics. So just being in the right thematic doesn't give you absolute confidence in the ability to deliver the returns. So without necessarily just talking about what's going to be different, I think there'll be quite a bit of marking of the scorecard around some of the areas where there's been a lot of investment, even over the last 5 years, but the expectation that there'll continue to be a lot of investment going forward. I think 5 to 10 years down the track, I still expect the thematics that we're talking about now will still be topical. Around the digital and data side, and the ability of power and energy generation to respond. That's not something that's, we talked earlier about a light switch. That isn't something that's going to get resolved in 1 year, 2 years, 3 years. There's going to be increasing need for compute, increasing need for digital infrastructure. That's going to keep compounding and, applying pressure to the generation side to keep up, so to speak. So I would expect actually some of these structural thematics will continue to be in place. And it will be a question once again of, like, well, given where we are, even though we will have been into these thematics longer, what's the best way to access them and deliver returns? I think some of the thematics which are newer for some, around deglobalization, will be playing through. What does that mean for infrastructure? I mean, I think here in the US, and we've been a very large investor in for example, the port sector for a long time. Invariably, you go through cycles, and the tariff posture of the US today is naturally impacting supply chains, and there is concerted government support for onshoring of production of certain goods. That will lead to the need for certain types of infrastructure to have heavier investment, but it can't be something that can be delivered overnight. So once again, with infrastructure, we're not talking about in and out of markets, making very quick calls. The way I think to be successful in infrastructure is very much this sort of long-term view. And, a lot of people quote the 4Ds, decarbonization, demographics, digitalization, and deglobalization. The key point there is they're table stakes. It's all about how do you invest in those thematics to generate returns for your investors. So I think, going back to this point around identifying the thematics is important. That sets your baseline. But really the question investors should ask themselves is, well, how are you going to access those thematics in a way that you can deliver the returns that investors want? And that's a second order question, but really is the most important part, I think, of infrastructure investing, and that'll remain the case as we go forward.
Yeah, that makes a lot of sense. And if you think about, you said, 30 years or so, other asset classes have been around longer, and they've had perhaps a lot of money come into them and a lot of enthusiasm. But then you can actually see who's done it well, who hasn't done it so well, which are the winners and the losers. And then when it comes time to re-up, you've actually got more to look at. So I think that it's a really exciting time in your space, because you've got as you said, the Supercycle is a real confluence of events that I'm not sure if you would have foreseen them 5 or 10 years ago. Maybe you would have, but this power AI, what happens with that? How fast does it grow? How much more efficient does it get? Are there more DeepSeek models? I think those are. It's just it's an area that it has so many facets right now. I liked your points about really looking at how the pieces of somebody's infrastructure portfolio fit together. It's not just one thing, but well, it is a long-term asset class, and I think that trying to think about the future is always always a challenge. But that's a lot more interesting than trading this afternoon. So thank you for your long-term perspective, your thoughtful way that you're putting capital to work, thinking about all of these stakeholders that you've got to think about as you deploy this. And it will be interesting. It will be interesting to see how this whole super cycle plays out. So thank you.
No, thank you for the time, and really enjoyed the discussion.